Wonderful, wonderful. So hello, good afternoon, everybody. Thank you so much for joining us today. My name is Laura Nieves. I am Head and Director of Investor Relations here at Astor Realty Capital. So today we are honored to have you, and we are going to dive in and explore the power of investing in real estate and equip you with the knowledge and strategies that you need to choose the right real estate project and the right sponsor to invest your hard-earned capital. You do not need to be an expert to invest in real estate in any sense of the word, but to have the basic knowledge of where you should invest and who you should invest in can really depend on the ultimate success of your investment. So today we are going to embark on a journey to assess real estate projects effectively, select the right sponsor, master due diligence, and ultimately mitigate the risk in your investment. So today is not just an opportunity to enhance your knowledge, it is a chance to empower yourself as an investor. We all know real estate can be a lucrative avenue for wealth growth, but making informed decisions is paramount. Whether you're a seasoned investor looking to expand your portfolio or just somebody who is ready to take the very first step into the world of real estate, we promise this webinar today will be a treasure trove of information for you. So, ladies and gentlemen, it is my pleasure to introduce our distinguished speakers today. First, we have Joe Burko. Joe is our CEO and a nationally recognized entrepreneur with a track record of over 25 years in making remarkable success in the commercial real estate finance and investment banking industry. Joe's illustrious career includes founding Burko and Associates. Burko was a New York-based advisory firm specializing in investment sales, structured finance, and syndication. Over the course of Joe's career, his innovative approach and dedication to ethical investing have earned him prestigious awards such as Power Broker by CoStar and the New York Signature Broker by Globe Street. These accolades highlight Joe's outstanding contributions to the real estate industry. And in 2009, Joe was also appointed as an advisor to the New York State Real Estate Board. He continued that role for 9 years under the leadership of 2 New York governors. And additionally, today I'm honored to have our COO, Marika Dinzinhashvili. She is a distinguished industry leader and has been recognized as a New York Real Estate Journal industry leader She was nominated the New York Real Estate Industry Leader to Watch Woman in Real Estate, and her visionary leadership and dedication to transparent communication has been instrumental in Astor Realty Capital's remarkable success over the last 10 years. So with a combined focus of real estate investment, we're truly in for an enlightening session today. Please join me in welcoming Joe and Marika. They're going to guide you through these topics. As always, please use the comments, the Q&A option. We want this session to be interactive. You've got industry leaders here with you who are willing to share their wealth of knowledge and want to ask you a question. So please feel free to drop anything. And of course, we'll be available after the webinar to address. So Joe, Marika, the virtual stage is over to you.
Thanks, Laura. Welcome, everyone. So
welcome, everyone.
The best thing would be to just get started on, how Astor even started, and definitely talk about Joe Burko and, start with his experience and slowly walk into who we are today.
Sure. I'll give a quick overview as to the why, right? It's been a fantastic book written about Start with the Why by Sinek. Essentially, companies focus on the how they do things or who they do it with and things like that. But I guess the most important thing is the why of the company. The why is where the passion lies. And my why, why we started Astor Realty Capital, or whether, better yet, maybe the bigger question, why I morphed a successful commercial real estate brokerage company in the heart of New York City, doing hundreds of millions of dollars of deals on an annual basis, and kind of like morphed it into private equity. So really, I'd like to start the story by sharing sort of like maybe an interesting pivoting moment in my career. It was sort of like the morning after I closed one of the largest transactions, actually not one of the largest transaction of my career. I was walking towards the bank to deposit a check. Time was around November. It was sort of chilly. I was wearing a very long trench coat, clutching in my right pocket a seven-figure check, reminiscent of the commissions from the evening before, where I sold a $182 million office building to a developer that was be buying the building to convert it into a 650 key hotel, the first Moxie hotel. And so, while I was familiar with that kind of like glorious walk with a skip in my step and sort of happiness, something else was going on. I couldn't help but feel frustrated from the way the negotiations have went, from the diminished kind of diminished feeling that brokers and advisors were bringing to the table, that was perceived, in my opinion, by the market. And really, I felt that it was kind of like the industry was changing, and it wasn't like overnight. It was just a period of a good amount of time. Couldn't help by noticing that Wall Street and Silicon Valley were pushing billions of dollars every year, finding way to disrupt the industry. And so, over the course of time, information that was essentially, available, proprietary information was available for brokers, became available to everyone, widely available. And I would often argue that most buyers and sellers today have access to so much information, they have access to everything, and yet they really understand the value of almost nothing. And so as the advisors, we used to feel like that there's like a lot of diminished respect to the profession. In New York City, there's gotten a lot of competitions. A lot of companies have started getting bifurcated, and smaller shops and commissions were getting squeezed. And I felt that it was very much felt in this very last transaction that we just closed. It took a good amount of months. It was a lot of bickering and fighting and all these different things. It felt more like, you felt that there was sort of like we used to say, the broker's job is to remove the emotions out of a transaction, but he didn't feel that way. And so I've taken a couple of good weeks right soon after to sort of like reflect and ask a few questions. What sort of a business I want to have going forward, and if I would have to start my business from scratch, what would I make it look like? What was going to look like? Other things that really occupied my mind and my questions were like, what sort of, where's my value add in the market? If the value add the bringing information, proprietary information to the market is no longer appreciated like it once was, what's my value add? And lastly, what really makes me happy? What really gives me fulfillment? And so early in 2015, I sort of like gathered my office and I share with them my thoughts and my insight and my sentiments. And I said that I feel that the value proposition of brokers today has been fairly diminished. We have a tremendously strong team with 25 sales associates at the time. We have a great reputation that we've built over the many years of professions and doing good deeds and doing good deals and making people a lot of money. We have tons of industry contacts, right? We've created phenomenal friendships and over the very many years, and we got a lot of experience. So that certainly does not go away. Um, I think that the second thing is, what's our value at? Well, the value of what the market is really looking for. Market is always looking for equity. Always looking for equity. Everyone's looking for money. I don't care if you're Blackstone or if you're a mom and pop type of an operation. You're always looking for equity. You're always looking for more capital to deploy. And I decided to morph my business to become an advisor with skin in the game. Why not put my money where my mouth is? If I know how to find deals, if I know how to analyze deals, if we have access to so much data and information, why not benefit and make it work in our favor? And so ultimately, what makes me happy? Well, getting fulfilled when I do a great transactions and people are happy around me. So today, when we close a deal, and we hand back the checks and the returns are higher than the expected performance, the warm and fuzzy that we get today, that I get today, is just something that I cannot put a dollar figure on it. And so I decided to morph the advisory business into private equity. Instead of advising others on how to lead and how to buy and why they should buy and so on and so forth, I decided to raise capital to transact through creating partnerships with best-in-class operators. And so this is how Astor Realty Capital was born. Everything gotten a lot easier once we've got this fine lady that's right next to me. I think together we are running the show here, if you will, in a very different level. I think Marika is first of all, she's my inspiration. She's also an inspirational speaker, specifically focused on a lot of a lot of insights from her previous years, and very passionate about women in business in general. Closed over $800 million worth of real estate business. A lot of it with us here at Astor. Originated tons of transactions, and is starting to get some awards as well. And so, it's been a pleasure, and it just makes the journey much more fun.
Yeah, definitely. We're just getting started. And also, for me, and I love, the story and the journey is so important because it's very different from how a lot of people operate, right? You can go to a manager, or you can go to a fund, and a lot of them don't always put their own capital behind everyone's deal, right? You can go and, yeah, sure, you can find great deals, you can have a lot of great knowledge about real estate, and like you said, today's investor is so different. All that information is out there and available, but how much depth do you really have in that information just because it's out there and available? So who do you have really behind you representing you? So when I joined Astor, and when I found Astor, that was some of the most pivotal points for me. It wasn't just the firm, it was also the people that were part of the firm, the knowledge and the experience, the deep background and the track record, everybody that's involved in Astor was extremely important for me to be part of. And that's something that I wanted to, join and grow together with. So on top of the inspirational speaking and everything, it's definitely extremely important to have a very knowledgeable team and background of people in multiple different areas. So I feel, today where Astor is a very, very strong area, because not only are we speaking with investors and, like you said, the mom and pop or the retail investors, we're also gaining a lot of interest from institutional investors and large funds and large firms.
That's how we started. Within a year or so that we've started Astor, we teamed up with a public company that has been our major backer. So that certainly helped propel our business forward. And of course, with it, the what we call the high net worth club of friends and family, who is initially obviously started, we started with practically friends and family, right? And then, that grew. Friends brought other friends, and family members brought their friends, and so on and so forth. Now we're capitalized by well over 300 high net worth individuals across the United States. Some of them are offshore.
That's an important point, by the way. When you're working with an institution, it's very different than just working with a retail investor, because when you're working with an institution, there are very, very different kind of reporting rights. There are very different type of things that you really have to look out for and make sure to watch, because the heaviness of the knowledge and the experience is on a very, very different level. So imagine joining, in an investment with a firm that is also working with a large institution.
Yes, I mean that actually goes back to the why. I mean the concept of allowing a company to bring on individual investors with relatively small checks, right? Relatively small checks into institutional size deals, and get the same type of treatment. Just like you said, I mean, the reporting that we have, the asset management part of our business, the analysis is completely different than, I would say, most sort of like mom and pop's operation or boutique operations. So I think that makes us a little different.
We'll definitely touch on that in regards to, the reporting that we just spoke about. I want to make sure that all our listeners really understand, what is the reporting? What is the asset management? How deep do you go?
Dive in.
That's part of what we're speaking about today. So let's just go over Astor real quick, so today we've already invested in over 26 different projects. Diversification is extremely important for us, for all our partners. So we seek out major job growth markets. So for us, that would be, Texas, Arizona, Florida, all over Florida, New York, surrounding markets, strong MSAs. So far, we've already invested in 12 major markets all over US. Our portfolio is valued over $2.2 billion. And, for us, the type of projects that we like to invest into, we like to diversify that as well. So we'll look at industrial, we'll look at logistics, we love multifamily, rentals, condos, and then we'll invest in hotels as well. So we have all that in multiple different locations. So
Yeah, very important. And also, like you said, skin in the game, right? It's so easy to walk away from a deal when you don't have skin in the game. And it's one of the pillars of us making a decision if we'll go into investment or not, is looking at the operating partners or our developing partners and really asking the question on how much real skin they have in the game. And you'll be surprised how many transactions that we're being asked to participate simply have sort of like a make-believe skin in the game, but it all sort of like shaved off at day one at the table, the closing table, because of fees and stuff like that. So it's really important for us to know that not only we bring our own capital and the capital that we represent, but also our partners, our operating partners have something to win and something to lose. That makes a very big difference. I want to take a moment and talk about the collective bargaining, which is sort of like our modus operandi, right?
definitely.
And I like to explain it in such a way. So what's the collective bargaining? So most of the individuals here on this podcast, most of our listeners are individual investors, right? So I want you to think about it in very, very simple terms. When you show up, and I'm assuming that you have some experience in real estate, maybe you're not a complete professional in real estate. You have some experience, you have some understanding in real estate, so you have some capacity to understand and to distinguish between a better deal and a worse deal and so on, at least on a surface level. Obviously, we live way below the surface. The devil is in the details, and so is God. So you go into a project, okay? Let's assume we go into a project and you show up with a check. Maybe your check is $100,000, very respectable size check. The likelihood that you're going to be able to negotiate terms on a institutional level project is close to nothing, right? You're not going to be able to negotiate terms. You're not going to get different terms than other investors, right? Maybe the total check, the total equity is maybe $20 million. Your $100,000 is not going to sway the developer and the development team to change things in order to cater for you. The difference is when we show up as a collective, we have the ability to better bargain. That's why we call it the collective bargaining. And I really want to spend a moment on it. So Astor Essential is we'll go over 800 to 1,000 transactions a year.
Yeah.
We'll analyze, we'll negotiate, we'll study, we'll bring 1,000 transactions a year, 800 to 1,000 transactions. We'll make offers in about maybe 2% of those. So maybe we'll make 16 offers a year, 20 offers a year. We will close on about anywhere from 8 to 10 deals a year. What does it really mean? 98% of all the stuff that we see, all the deals we're being offered, we say no to for a variety of reasons. And that's an important point because as a non-professional, how would you know to distinguish really what's the difference between those deals? And we say no for a variety of reasons. Sometimes it's lack of experience. Sometimes the numbers are too rosy and are kind of far away from reality. Sometimes we don't like the certain market for a variety of reasons.
Not only that, imagine how many individuals actually go through 1,000 deals a year
Nobody.
on their own.
Nobody.
You'll most likely probably look at 10 tops, maybe 20, even if you're extremely involved in real estate. So not only that, you actually have a lot of real estate also to compare to, and not just in one state, it's in multiple different states from multiple different layers of type of projects to really compare to.
So you have a partner, us, right, in this case, or a company similar to us, that's vetting the project. And so once we go through a very heavy vetting project, we go through a 60-point due diligence before we say yes to an absolute project and we fund it. We're able to drive a few key items. One of them is our ability to make major decisions. So imagine, so you show up with $100,000 check, or a group like Astor shows up with maybe, $10 or $12 million check, maybe $60 million check, right? We have the bigger sway to get a couple of things. First of all, we have takeover provisions. We have major decision rights, right? We have the right to prevent the project from taking a bad loan, hiring a bad contractor, changing the project, delaying the project. And there's consequences to all those things because we're seeking yield, right? The longer we extend the project, the lower the yield goes on an annual basis. And most importantly, well, maybe not the most important thing, but certainly very, very important, is that we are able to get better terms. If the typical split on a waterfall split, if you know what I mean, right? Once you get the money back and you have splits, if the typical split is maybe 60-40 in favor of the investor, maybe after an 8%, we tend to have much better splits. So we reduce the amount of promotes that our managing members or developing partners receiving significantly, sometimes by 50%, sometimes by more. In other words, retaining a lot more of the returns in this side of the equation, and you, the investor, end up making a lot more on the very same project. So not only will you have us as a partner, making sure that we choose the right project together, not only will you have our capital in as proof statement to say, hey, my money where my mouth is, I have skin in the game, I take the exact same risk as you. We're also going to make sure that throughout the next 2 years, 3 years, 4 years, we're on the numbers, we're checking, we're verifying, we have special teams that go into various projects to make sure that we're on time, on budget, and the developer is doing what he's supposed to be doing. And if not, our legal docs are such that we'll have the right to change things, to penalize, to take over in certain rough situations, just to make sure that there's preservation of capital and you get to know what is going on because we report to you. We get reports out from the field and then we compile them and then we report to you. And I think that that's an important aspect.
Yeah, it's definitely a very important part. So the conversation of due diligence, for us, when we have a list of the due diligence, I feel like, most people would never even imagine to go that far or to look at so many details. And, Joe, you mentioned, doing the due diligence on the project, but what about also the due diligence on the partner, the developer or the sponsor who has a project? There's the due diligence on that area as well. Let's talk about also the due diligence on the market. Is that type of a project right for that market at that specific time, right? For example, we've invested in a hotel when we were looking in Arizona, right? So when we're looking at that location at that specific time, when we were looking at that project, said, you know what? Multifamily is probably not the right time for this specific area. So we're going to go into a hotel. Not to say that hotel is right for every area. So those are also the specific type of due diligence that we do. Now, also on our partners that we're going to create relationships with, that we're going to, invest together with, we're making sure to look out for everybody's hard work, money, our partners, our investors, everybody. So we also make sure that the partners that we come in with, we check that background too. So, when you're doing things on your own, make sure, either you work with a firm like ours, or when you're doing it on your own, make sure that you're driving those due diligence points. For us, we have an entire robust team that goes through all of that with a lot of knowledge. So those points are
absolutely.
important
And
as
you you sort of like touched a very interesting line. We love certain markets, but we love certain markets for a certain product type. Like Marika mentioned, we got into Phoenix, Arizona to a specific project. We looked at a lot of projects over there. It's a booming market, lots of products coming in, but that's exactly why we decided not to go multifamily, because we're looking at a huge pipeline, right? We're analyzing the amount of new product that's coming in and new construction starts.
Yes.
It's like, well, we don't know that this area can sustain this type of wave of multifamily, of single family that's coming to the area. Is going to be some sort of an adjustment. A new equilibrium point is bound to happen. And so while we love the growth in Arizona and specifically Scottsdale, we decided that what's missing in this market is not more multifamily. And so we entered into a phenomenal project that you've originated called Caesar Republic. That's the first beautiful project, which was the first non-gaming Caesars, 165 key hotels. We're about to open it in.
We're about to break the champagne glass on that and
That's
do our
right.
cheers.
CFO is
months, so
CFOs, exactly.
that.
Exactly. So we're looking at around March of next year. It's gonna be super cool.
Yeah.
Um,
Let's also mention one more project, something similar. For example, the project that we have in New York, 58 St. Mark's. So it's
St. Mark's, right?
Similar idea, right? So like,
Yeah.
what was the pivoting point? Where did we make sure that that was the right point, that was the right partner at that specific time?
That's a great point.
New York is a tricky market,
Very
right?
tricky market. So in New York, for example, we'll watch for anything that has to do with political risk. So New York is a very resilient market. Obviously, New York is going through a lot right now. The political headwinds and the way things are running around, it's a little bit tough right now to own multifamily. The rules are in opposition. It's not the most friendliest place for business. So when we invest in New York, we invest short term. Why short term? Because I don't know what the politicians will end up doing the next 2 years, 3 years, and so on. So most of the projects we'll do in New York will actually going to be focused around condominiums. Because condominiums, you build it, you sell it, you move on. You don't hold the product, you just move on. And so one of the first large projects we've done in New York was 58 St. Mark's. It's in Brooklyn, booming market. We found an amazing developing partner, tons of experience. At that point, about 25 years, focused only in Brooklyn, never built anywhere else. And we felt very comfortable to go after that product. It was a 100-unit condominium. We underwrote it conservatively, if I'm not mistaken, around $1,250 a square foot. We outperformed that one. The market, we catch tailwinds of the market coming right out of COVID. The market was on fire. We used to sell, I remember every weekend, we would sell about 6, 7, 8 different condo units on a weekend. It was just, every weekend was a whole party. It was just a moment in time. But, you could tell that the market was strong. It was undersupplied. And the units are essentially, it's a beautiful building, by the way. The facade in this particular picture doesn't do justice to how gorgeous the inside of the building is. Tons of amenities. And it was so well perceived by the community. So we really did see much better pricing than we've anticipated. And of course, that trickled down to higher return to our investors. Now, nothing is perfect, right? We went through a COVID period. Things got longer, supply chain issues, get material took longer to.
However, through the COVID times, people were having difficulty, but I don't want to brag, but I do want to make sure to mention, that we did pretty well during that time, even though we made sure we know when to take a break and when to pause.
Right.
But, throughout that time, our projects were doing really well. And that's really based on, because for us, because we focus more on ground up projects, we look at, where our project will be, what the market might look like. You always say, we live in the future, right? When we look at deals, we have to really also not just look at a project like how is it going to do right now. We have to really look into the future and look at, say, for us, our like you said, our time horizon is typically around 3, 4, 5 years max. So we have to make sure that we really know all the markets and know all the details and underwrite in a way that will know what will be successful and when should we enter into a project, right? At what year?
So timing plays a very key role. Before we'll go and have a quick conversation about the time, I want to kind of like pivot back to where we got everyone here for, and that's sort of like choosing the right project for you. So if you look at real estate projects, there's multiple options, right? Real estate projects can range between ground up projects, right? You'll enter the investment. You'll go through a period where there's going to be planning and then building. And then if it's a rental building or a condo, it will go through stabilization or through a sales period. That will typically take between 2.5 to 4 years. And at the end of that, then you'll see the returns because you're taking on some, a certain amount of risk associated with the ground up construction, associated with changes in the market. You want to get paid for that risk.
Yeah.
And for that, I mean, we're looking for very high teens for our investors into the 20s, into the mid 20s. Certainly if we're in a condo, we're looking into the mid 20s. So that's very important for us. But you as a passive investor, the questions that you need to ask yourself, are you okay to part with your money for a period of 2.5 to 4 years? And are you okay not to generate any income, but get everything towards the end, one lump sum? Our average, I think, is around money in, money back out with around 75-80% return, cash on cash basis. We've done deals that, have done significantly better and more than double in a short period of time, but I'm just giving you the average. Other projects that you can choose from are projects that are giving you some kind of a current income and kind of like money back and a little bit more of an exit. And those will generate around double-digit returns, teen returns, 12, 14, 15% returns. Those we call preferred equity positions. The reduction of risk is apparent because the priority of capital immediately after the bank's capital is that of the preferred positions, right?
Yeah.
So if you'll think about the capital stack for a moment, there's a bank who gets paid first at the exit of a project. The bank always gets paid first. Then we'll have the sliver of preferred equity. And for example, if Laura can put up the example of the legacy project, I think that's a good example. We can talk about that. In that particular deal, we've created income flow. Those particular projects, the legacy as well as
two different ones, right?
So we've created an income stream to the investors. The one on the right side represents a 6% to the investor on an annualized basis. Legacy project. It's a beautiful project in downtown Miami, 50-story building, 310 condo units, fully sold. The middle of the building has 219 hotel rooms managed by the SLS, a brand of Accor, one of the largest hotel brands in the world. The bottom portion is medical office, mainly leased out
wellness,
health and wellness and that sort of a thing. So we've created a preferred equity positions. Our investors are making 6% return throughout the holding period on an annualized basis, and then a 9% catch up. So to make it a 15% annual return to the investors, plus there's another what we call an equity kicker. And so you get yourself some sort of a current pay and then a nice little exit of another 9%. And that's sort of like the preferred position. You'll get the money immediately after the bank is getting paid. Project on the left side of the screen is called the Junction. So that was
our value add project.
Yeah, a value add project. So
in Texas.
Yeah, go ahead.
So first of all, I just want to also just mention, by the way, you see you're discussing, all these different projects and entering in different ways, right? Those are also really important points that we touch on is, how do we invest? So when we'll look at projects, we'll also figure out, and it's part of our negotiations as well, is what are the structures that we're coming in with? When you come in with common equity, it shows different kind of returns. When you come in with preferred equity, you have to get very creative with how you negotiate and everything. And all these projects also show different, some of them do have cash flow that are projects, these are the ones that
That's right.
that we're talking about. And on top of that, also, investors are in multiple different locations, so not everybody can really fly out and make sure to go see those projects. So we make sure that
Mhm.
we'll visit and fly out and go to all the properties and spend time there.
Yeah, that's part of what we do. But going back to kind of like the structure of the deal is, when we do preferred equity, the project on the left is a good example. That one pays 10% ongoing basis to the preferred investors, and then a 4% catch up, 2 to 4% catch up, for a total of 12 to 14% at the exit, right? So those projects you generate for yourself returns. They usually tend to be short duration projects, typically a year, a couple of years, or 18 months. And that's a different type of element than, let's say, investing today and making, 20, 24% return per year, but seeing everything at the back end. So you as a passive investor, you have to ask yourself the question, do I feel comfortable investing long-term, making much larger return, but parting with my money for the next 3 years? Or do I want to see, or do I need to see income along the way? Those are very important.
Yeah, those are the reasons, for us, it's really important to get to know everybody that invests with us, really understand what their needs are. It's not just our investors just coming in and getting into a project like a crowdfunding site, getting on the website, click here, there, and I'm
Send the money.
in, send the money. Where it's going, I didn't even speak to
The
anyone.
non-friction, the non-friction.
The
I love
non-friction, yeah.
this. I love this notion, how in this world, sort of like the concept is talk less. I don't want to know you. I don't know who you are. Click here, send the money, sign this online, and we'll send you your money. We'll tell you what's happening with your money sometimes down the line. We're so the opposite of that.
Yeah.
Every investor that we bring, we make it our business to meet with them over Zoom, over a phone call, to understand what they're looking for, what they want, what's their aspirations, why they're investing. Yeah, we're a little bit.
And
Yeah.
to make sure that they do have the ability to reach us. It's
Right.
not just, send me an email and then wait a couple of days.
Often makes me wonder. Often makes me wonder what makes people feel comfortable by investing without friction, right? Without friction.
In the way we work at this point, you don't really need to have friction when you're investing, and everything's very streamless and easy. But the area of that personal connection and that personal touch of us really learning about who every individual is and what their needs are, and really understanding, when we do look at deals and when we do look at projects, we also make sure that this is for our investors and that's what they're looking for and that's what's important for them as well.
Right. Very true.
So it would be good for us to move also a little bit to what the market is today. Let's talk a little bit about.
But let me just summarize how we sort of like look at, how we look at transactions. And I want to leave the audience with some basic tools. So we totally recognize that you need diversification. Diversification is extremely important. I don't put all my money in real estate. I need liquidity. Real estate is an illiquid market. So some of my money is in the market. It's a roulette for me. It's a casino. I don't know. It goes up, it goes down. No rhyme, no reason. But I do have to have some liquidity. Other parts of my capital, the vast majority of my money goes into a variety of projects. All of our projects we're investing. But I totally understand that you need to do the same. You need to create diversification, even within managers, right? You don't want to have just one manager. If you have one manager until today, consider expanding and maybe working with 2 or 3 different managers that you like, that you found, that you vetted, that you checked out, that you maybe got some good references. It's important for us, before we choose a project, we call it the triple C.
Oh, that's
What are
right.
the triple C's? Okay, right?
Very important points.
What are the triple C's? So the first one is the collateral. That's the first C. Do
Mhm.
we understand the real estate? Do we understand the collateral? Do we like the collateral? And if we don't, we abort the project. Because every plan has a plan B. If we cannot have a plan B and we don't do the project, the collateral is extremely important. The second one is credit.
Yes.
Credit represents for us the ability to bring a bank or a lending institution into this project. Can we finance this deal? What sort of financing we can obtain? Is the operating partner financeable? Do they have deep pockets? Do they have capacity to withstand shifts and changes? Right? You don't want to work with somebody who's broke, who's on his last dollar. Certainly don't want that. You need people that have the ability, a financial ability to withstand shifts and changes in the market.
Yeah. And that's a very, very, very important point because shifts and changes happen all the time.
Bound to happen. It's bound to happen. We take those into our consideration. And I think the Class C, which is often overlooked, you can't put empirical data on it, and you can't put an Excel sheet around it, and that is the character.
Mm.
A lot of attention we spend paying attention and listening very, very carefully, very intuitively to the operating partners. We go to their offices, we do background checks. It can go sometimes back as much as 25 years back to pick up anything, all the closets, all the skeletons are coming out of the closets. But beyond all that good stuff, the character, most deals, most real estate deals are really not complex. They're really not rocket science. What makes it complex is being in partnership with the wrong partner. Somebody with maybe a large ego, somebody who always think that I know better than you, or I'm the smartest person in the room. We tend to move away from those individuals. We don't want to go down that path. We want people that high level, level-headed individuals with good nature. Things happen. There's a lot of stress during investments, certainly during development, and choosing the right partner. And that's something that goes towards friction, because I look for that friction. I seek that friction. I am not going to do a deal without sitting down with an operating partner and spending good time in their office and spending good time seeing their projects and walking around and meeting their staff and their C-level executives and walking through their offices and understanding what sort of a partner do I have. Because the data is one thing, the character is a whole different conversation. I spent 28 years in New York City. I've done hundreds and hundreds of transactions, being the linchpin, being the centerpiece between buyers and sellers, borrowers and banks, attorneys on both sides, and everybody's talking, right? Everybody's talking to the centerpiece, the negotiator. And I can tell you, over so many years, large transactions, high octane deals, I've seen the best in people, but unfortunately, I've also seen the worst. I've also seen the worst in people. And so what I've learned is listen, intuitively listen, because people will tell you, you may not want to hear, you may not want to listen, but people will tell you everything. You just have to learn to listen and ask. So these are the triple C's. And for us to do a deal, we got to move from triple C to a triple A. And that's essentially what I want to make sure that you, the listeners, are out there taking all this stuff in. Okay. So it's the collateral, the real estate, it's the credit, the ability to bring financing, the ability to fund the deal, the ability to fund the situations if there's cost overrun or something gets lengthier on things of that nature. And the most important thing, the one that's really tricky, it's the character.
Yeah. And by the way, the character plays a very big role in certain moments when, something will come up in the moment during the 3 to 4 years. And it's, how do you sit down together and really work together as a partnership? That role of character comes up in those kind of situations, and really being able to work together to improve and to grow and navigate through those challenges. That's exactly when that character really comes about. And whenever we do find those characters that we really love to work with, we make sure that we create a very long partnership with them, and we'll do multiple projects together with them, and through the years. And we already have many projects where, with the right characters and the right partners, we'll form long alliances.
True. Some of our partnerships are going on project number 4 and number 5 with the very same groups. We're very happy with them. We tend to do well and many times even outperform.
Yeah, just imagine having to do all this as an just on your own as an individual, trying to navigate the partnerships, the character, the meetings, the flights, and all of those things.
Diligence, the ever changing market conditions.
Listen to
I don't know why people do it. Maybe it's because they don't know that there's alternatives.
Yeah.
If I would simply say to somebody, look, you can invest on your own, make a choice. Most likely you may or may not do the right choice. And you'll get less of a return because your operating partner will see you as a small fish. And so it'll give you worse terms. Or you can come in with us. Let's make together a collective syndicate and show up. And then you'll have operating partners on your side, running and helping you, making sure that we do the right decisions, watching your capital, watching the project, reporting to you. And at the end of all of this, you made more money.
Yeah.
I think it's a no-brainer. Let's move on. I think we have some questions, and let's just move on here. Is there somebody popped a question, Laura?
Hi guys, yes, I have answered them, but we do have a couple of things that you could go into a little bit more. Talk to us, Joe Marika, about our accredited and non-accredited investors. Perhaps give the audience just a very little summary as to what an accredited and non-accredited investor is as well, just in case we have anyone in the audience who doesn't know.
Yeah. So Arne and Joe, I'll let you go into the details, but for our end, we definitely work both with accredited and non-accredited. There are certain projects that only accredited investors are able to work with. But however, there's certain moments where we give those opportunities and people can join us as well. You want to go into?
Sure. I mean, the accredited investor is considered an investor that's well off, defined as at least making $200,000 a year as an individual, $300,000 a year in income as a couple, or has at least $1 million net worth, excluding the personal home. And that's essentially the definition of an accredited investor. Some projects and the way we are guided by the legal documents and all the compliance documents that we bring to every project will allow us to pitch projects to only accredited investors. And so we'll note it early on. And so we might say, look, this project is only for accredited investors. Other projects, we're able to approach sort of like a wider audience. And that's for non-accredited investors, maybe smaller investors. We are able to take smaller checks. Typically, the checks that we take on the smaller side start at around $25,000. Whether you're accredited or not, and we'll kind of like give information. So a non-accredited is someone who does not meet the criteria that I've mentioned. Again, accredited, $200,000 a year, and you have to show it for a couple of years in order to kind of like not show that it's a fluke. And that would be $200,000 a year, $300,000 as a couple, or $1 million net worth, excluding the value of your personal residence. And so that will be considered accredited. So why is that important? Because, the authorities that are out there are indicating that, if you are speaking to an investor, they want to make sure that the investor has some knowledge of the type of projects that they're going into. They're obviously concerned for people to be taken advantage of and things like that. So if you're able to get yourself that type of a salary, and if you're able to accumulate that type of money, chances are you're a sophisticated investor. And if you're a sophisticated investor, then you can handle yourself. If you're a non-sophisticated investor, and that's smaller projects and sort of like a little bit of a different marketing that tends to be. A lot of the folks that we work with are accredited, and some of them are not. The only way to distinguish for us is that when we choose on a specific project, depends on the size of the project, will allow accredited or non-accredited. We do have projects where we have a mix of both, and that's usually my preference. Everybody should share. We take the large checks from the institutional groups. As I mentioned earlier, we're backed by a public company from overseas. We usually will take the larger check from them, and then we'll leave the smaller amount, the last 10, 20, 30%, sometimes 50% to our club of friends and family. And then we'll start with small checks. And what we found over time is that people give us a shot, new investors give us a chance. They like the way we work. They like the returns. They like the ongoing communication with the team. with the reporting that they get. They see the difference. They understand the difference between working directly, maybe with the developer, or working with the collective bargaining that we bring to the table. Tend to get better returns and much better service, quite frankly, along the way. And so we kind of like build from there. So they start with smaller checks, and then it grows from there. The other thing that we see very, very often is that when people are happy, they're not only they return and do business with us, they also tend to bring their friends and friends of their friends and so on. So we always grow organically. We almost never advertise. And that's just our style.
Wonderful.
The
Thank you.
friction. We're the friction people.
Yeah. It's also some people might not even know if they have an accreditation. So there are ways to be able to get accreditation. We help, guide you on that as well, and how to do it. Your accountants can help you. So there's
It's really
many
not that
ways.
complex.
It's very easy.
Very, very simple stuff.
Is there another question?
Yes, if you can please go into, Joe, the possibility of a 1031 exchange and investing with Astor Realty Capital.
So a 1031 exchange is, for those who are not familiar, is the ability to defer taxes on the sale of an asset. And so the IRS allows you to take a certain period of time and reallocate the capital to a like kind of an asset. So if you sold a building, then you'll have to buy a piece of real estate. If you sold a business, then you'll have to buy a business. It has to be like kind. In our case, not always we're able to accommodate a 1031, but we are always creative, and we're always able to create situations to help somebody or a group who has a tenant in common situation to perform a 1031. How do we do it? We're going through a similar exercise right now. An asset that we've acquired a couple of years ago, we're able to bring a 1031 partner because we're looking to recapitalize a portion of the asset to bring additional capital to the project. And so, we have a team of legal, a team of attorneys, and certainly enough of a wherewithal and understanding to either get you to team up with our raise, create your own sliver, your own tenant in common sliver to enter the transaction. So we're able to do that. Not every project is a fit, of course. Some projects are a little bit more tricky to do it. The bank also has to agree. And so long that you give us enough of a time frame, if you're on contract and you're closing in a couple of months, give us a call early enough, we'll be able to accommodate. Great question. I wonder if somebody have any questions about IRAs. It's also, we're seeing a lot of capital coming from IRAs.
Yeah, definitely. It's important to be able to work with your, IRA. We bring in a lot of specific projects that actually work really well to bring money from an IRA, because it helps with the taxes, and specific projects like on the condos that we have. Those are like the best to place your money from the IRA.
Yeah, absolutely. Good point. So IRAs, we absolutely advocate that if you're entering a condo project with us, and those tend to pay the best. There's if the project doesn't pay our investors 24-25% annum, 22, let's call it that, the minimum, we wouldn't do the project. Those are the projects that tend to pay the best. And because from the IRS standpoint, a condo project, at the sale of the condo units, you're essentially selling inventory. You're going to get hit with ordinary income, right? When we're building a building, or when we're buying a building, renovating it, and then selling it, we're looking at long-term capital gains. So that's around the 20% or so. Depends on which state you are, but on a federal level, it's 20% income tax. When you're selling condominiums, when we build a building, we're selling condominium, it's ordinary income. So it depends on your tax level. You might find yourself at 45%. And so we always advise folks, do it through your IRA. And if you don't have an IRA, shoot an email to Laura. She'll make a connection. What an IRA essentially does is it allows you to take savings, on an annualized basis, to save from your income, put it into this self-directed IRA. It's kind of like your own safety bank, your own savings bank that is designed for you to invest where you choose to invest, right? It allows you to invest. So for example, if you're running a self-directed, and if you have some sort of a some sort of a private owner of a business, you're able to address it and invest as much as $60,000 a year, and sort of like move away from for a portion of that to be taxed. And once you invest that capital, you're able to allocate where you should invest it. And if you put it in real estate or in other assets, it's entirely up to you. The point of the matter is, income generated out of those investments are deferred. So long that you don't break the IRA, your income is constantly deferred. So imagine that. Imagine you had $100,000 to invest, and we're able to generate for you, let's assume a double, right? Instead of paying taxes, those taxes are deferred. So now you have a nest egg with $200,000, and then we're able to generate for you again, and all those taxes are deferred, which means the tax money that didn't get paid out is still there working for you. This is kind of like a really smart way the IRS created, because we're all, we're not the best savers. We're great spenders in this country, one of the biggest spenders economy, but we're not great spenders. So look into an IRA, and if you're not sure what it is, shoot an email to Laura, and she'll put you in touch. We have a few that we work with, of course.
Yeah.
There's many to choose from. I certainly have two that I work with. I'm very happy. I put money there every year, and it's
Also,
important.
periodically, we do live webinars with some of the IRA firms as well to go deeper. We even have some videos on our website that you can watch as well, talking about how an IRA works. How can you get started if you don't have one? So there's a lot of information on our website about that as well. Any other questions?
Beautiful. That is it for now. I'm just reminding everybody, please, if there's anything that you would like Joe or Marika to spend a little bit more time on, please drop it in the comments or in the Q&A option, and they will gladly dive into it. So Joe, Marika, would you like to spend a couple of minutes? We are approaching the hour mark, but I'm sure the burning question on everyone's mind, perhaps hesitating them taking the next step, is current market conditions. Where should we be investing today? How should we be investing today in this uncertain economy?
Yeah, the $64,000 question. Where are we today? Well, what do you think?
64,000 specifically.
Where do you think we are today in the market?
I'll tell you, I think everybody comes with very different ideas and very different opinions. It depends on who you're listening to and what audience you're in. So
what time of the day
and
you're
what
listening
time of the day you're listening to, right? So let's start with first how we've been looking at the market so far. We did take how I like how you call it, a chill pill for a couple of months. So we were
15 months, not a couple of months. Yeah,
right.
From the summer of last year, we decided that the market is obviously dropping and dropping fast, and so we don't want to get caught in it. And it's falling knife syndrome, and so we decided to put a pause. We've had a couple of commitments that we had to fulfill, of course, but we've done no new business until May, June of this year. So it was a 15-month pause, just to let the market reach what we think is now the bottom.
Yeah, so we have been, definitely tracking the market and looking at different things, but what we're starting to see is business is definitely starting to pick up.
Yeah.
There's a lot less fear out there and a lot more hunger and curiosity. Capital is definitely out there. What we're seeing is, just waiting for the right deal. I'm ready to go in, I'm ready to invest, but when is exactly the right timing and when is the right deal? So, Laura, if you can just pull up a couple of.
Yeah, let's take a look at empirical data, and I think we'll sum it up with this. So where we are in the market. Well, let's stick with let's talk about the dreaded I word, inflation. If you look back to last summer, inflation peaked at around 9.1% in around June of last year. Certainly a very, very hard time when you're in real estate, transitional real estate. Inflation is at 9%. Your interest rate have moved from 3.5% all the way up to 7, 8, 9. Very, very hard time to maintain real estate when interest rate triple in a very short period of time. Right now, what we're seeing is inflation have dropped down significantly to about 3.6 to 3.8%. It's a sharp drop. very, very sharp drop. So much so that the key Fed rate is now above the core inflation. What does it really mean? It means that we're now seeing an equilibrium that interest rate is above core inflation. The Feds are bound, as long as this trend continues, to drop interest rates. So it's going to happen. However, the Feds are smart. They want to wait for 4, 5, 6 months to see that this is not kind of like a blimp, to see that this is in fact a trend. And if you look at core inflation, and it kind of like move away things that are super volatile, such as energy or food products, and core inflation last month has been less than 1%. So long that this trend continues, we're on the right trajectory. So I think we're at the very bottom of inflation. What's the other thing? Absorption in multifamily has been very, very strong, just shy of 100,000 units. Okay, demand is very, very strong. There's
Absorption.
Absorption has been very, very strong. Demand for multifamily has been very robust. And while switch over to the next slide, please. And while we are seeing the pain in folks that are trying to buy a home, interest rate, because of inflation, interest rate is very high today. I think your 30-year mortgage is about 7.25%, 7.5%. Obviously, very expensive. And so if you sort of like do a buy versus rent type of a scenario, you'll ask yourself the question, I could rent here and pay, the $4,000 a month, or I could buy the very same condo unit, and between my mortgage, HOA and everything, it's probably going to cost me about time and a half what I could be paying in rent. The buy versus rent type of a scenario doesn't make it too appealing for buyers to transact. And so much more of the I'll stay and keep on renting.
Yeah, and we've
is
been hearing
happening.
a lot of that too.
lot
We've
of
been
that, yeah,
seeing a lot
yeah.
of that and hearing a lot of that.
Absolutely. So that's, there's a list over here of sort of like, the biggest annual income changes that you needed to have in order to be able to afford a new home in certain markets. And the jumps are tremendous on average across the United States in order to catch up with the cost of housing, whether it is a new home, whether it is condominium. The rise of that, your income should have gone up by an average of 88%. And I don't know too many people that have nearly doubled their income in the last several years. That's for sure. In some markets, it's even a lot more severe. So a lot more people are still renting today and waiting for that golden opportunity where interest rate will drop enough that they can afford a home, and that hopefully they'll catch that golden moment before prices will start shooting up to the sky once again, because that's really the inverse correlation between interest rate and values, and that's the way it works. Next slide, please. What do we have? Supply chain. Supply chain, right.
That has been a very long conversation, the supply chain, especially because, we're in ground up projects. So we've been hearing those conversations from the beginning of the year, and how
Hearing it and feeling it.
feeling it
Yeah.
as well. Yeah.
Yeah.
And through towards closer to the end of the year, I would say it definitely has improved and has eased off and removed a lot of pressure as well.
Right. Yeah, I mean, if you look at kind of like 2 years back, 3 years back, supply chain was a real big conversation, was a real big issues. Factories around the world were shut down or were working on a sliver type of an operation. To get shipments from one continent to the next was extremely expensive. Everything was backed up. And so everything became super expensive, right? To be able to find product, to find material for building supplies, all sorts of different things, has been extremely expensive. Just follow one particular trend, and that is the container, the shipping container. Be $16,000 to ship container. Now it's down to about $400 or $500 per shipping container. It's a very, very large difference. And so we're talking about, large changes. It used to be a tight issue. Now it is all loosened up. The factories are open all over the world. The factories are open. Supply chain is no longer an issue. You can get what you want and you can get it at better pricing today. So we're seeing that relaxed a lot more.
Yeah, another thing also, when we say, oh, it went down, more if you look really closely to the chart, if you look further out, all the way till 2019, I would say the supply chain has kind of rebalanced itself to how it was before, because the prices went extremely high. It was abnormal to how it was before.
Mhm.
So how it is today is actually, rebalanced. It only went down if you look 5 years back or 3 years
Mhm.
back.
Yeah.
So as of today, it's back to how it always has been.
Yeah. Pre-pandemic, kind of like the world pre-pandemic,
Yeah,
2019,
everything,
2018.
how people were looking at it was
Yeah,
extreme
Yeah.
on
And
extreme levels.
that's also had a very big impact on cost of material. We've seen not everything was factory related. There was, for example, one large component was lumber.
Yeah.
2, 3 years ago, 2.5 years ago, if you were to be acquiring lumber for your construction site, for your building, um, it would cost, about $1,600-1,700 for 1,000 linear yards of lumber. Just understand that it wasn't that long ago, in a short period of time, it moved from about $350 or $400 per 1,000 linear yards. And so there's a huge impact on those costs. Now, all of that is actually coming down,
Yeah.
and it makes it a lot more
It
sustainable.
also makes it easier now to finally make sense of the numbers of projects. They're not when we were looking at projects, the underwriting just didn't make sense.
A lot of
So
projects, yeah.
everything that we were looking at had to be constantly updated.
Right.
So,
Right.
everything's fine. When we're looking at the numbers, we're not looking at last year or 5 months ago numbers. We're looking at everything as of today as it is now.
Reason why 70% of construction starts are down. We're down 70%. Which again goes back to what you said. We live in the future. If construction starts are down 70% year over year, and we're building, which means in 2.5 or 3 years when we'll meet the market, I'll have a lot less competition,
Yeah.
pent up demand. We'll be able to control prices better, push prices, and maybe outperform. So those are the things we're looking for, and this is why the bottom is a very, very frugal time to invest. Let's continue the next slide. Labor markets, we've spoke about a lot, where labor markets, are doing great. It's unemployment is about 3.8%. Just last month, the numbers came out, 300,000 new jobs. These numbers are tremendous. There's been a lot of conversation. There's going to be some soft landing. I think we've landed, and I think that has been the soft landing already. We don't see the other shoes about to drop. Yes, there's other concern that we're paying a lot of attention to. Maturing, a roaring wall of maturities, mainly on office, commercial, and residential multifamily. And so those are still kind of like out for deliberation. But even those, the amounts in percentages, right? The amount in percentages represents a very, very small amount. I looked at the chart a couple of weeks ago, and it was quite interesting. The biggest collateral, the biggest issue right now is in office. Office, you can see it's sensational frontline headlines. Biggest companies are handing back the keys back to the bank. But if you look at office as a component of all lending criterias, right? All lending criterias of banks, it represents 3% of the entire lending pie. Now, not all of that 3% is going to default, right?
Yeah,
There's some good office buildings that are doing pretty okay. I mean, if you walk around Miami, we're in Brickell right now.
So it's like office and then office where?
Right. Well, it's two different conversation, but but consider office, as its own component. If you're in Brickell, it's a tale of two cities. We're like a block away from a building that's charging $200 per square foot on rent, and it's got more demand than supply. So not every market is experiencing what New York, San Francisco, Los Angeles, Chicago, Boston are experiencing,
Yeah.
right? So that doesn't mean that the entire office segment is going kaput or going down. There's going to be pain. There's not a doubt about that. There's going to be pain. There's about $67 billion of multifamily that's expiring next year in 2024. It's a big number, and a good chunk of that, probably about 20-25% of that, are the floating rate mortgages. All of that stuff is coming due. And if you are over leveraged, then you're going to have to find capital, because the loan that you carry today will not underwrite with the interest rate that is kind of like existing now or going to be next year, right? And so those you got to watch out for. But like Marika said, there's like so much dry powder out there.
Yeah,
Then
definitely.
there's money that's seeking those opportunities. And there's going to be a lot of recalibration that's happening, a lot of joint ventures, preferred equity positions. The market will sort itself out.
Mm.
And so ultimately, without going into too many details, we believe that this is the bottom. We are now in an opportunity time. And if you can put the words of Warren Buffett, who said something very interesting, be fearful when others are greedy, and greedy when others are fearful. So I disagree with what you said. There's a good amount of fear going out there. There's a good amount of uncertainty, but that's exactly what the bottom is. It's exactly what the bottom is. And this is opportunity time for us and hopefully for you, the investors. So I think we'll wrap up with that. Looking for all of you, I hope you've enjoyed our conversation here. Please scan me and Marika and be in touch with us. Take this.
Touch with us.
Yeah. We'd love to talk to you. We'd love to have a one-on-one conversation. We'd love to see if there's more opportunities. We'd like to invite you to our various pitches as we're bringing new opportunities to the market. It doesn't mean that you have to invest, but get in the conversation, get into the education, learn as much as you can, and hopefully we'll do good things together. Thank you very much, everyone.
Thank you for joining.
Thank you so much, Joe and Marika. That was an absolute pleasure. Everybody will get the recording of this webinar. And if you do get in touch with us, we have our contact information here. Thank you again for joining us. Have a wonderful evening.